So now we're going to do the bank reconciliation, because checks can be such a big element of internal control. So checking account is a big element of internal control. Now, I know for most of us, we just kind of call up the bank, or we actually look it up online now, and we just kind of click off what we've done and see how much money we have. And then in our head, we might also be thinking, well, I also spent this money, but it hasn't cleared yet. So in your head, you're doing a little bit of what's referred to as a bank reconciliation. But huge businesses that have millions and billions of dollars, they actually go through a formal process called a bank reconciliation to make sure that what they have in their accounting records ties to what is going in and out of the bank. All right. So to do a bank reconciliation, you use the bank account. And every month you'll get a bank statement. All right, the bank statement shows deposits that have cleared the bank. It shows checks that have cleared the bank. Shows debit card transactions. Electronic funds transfers, which are EFTs. It shows Nsf checks. And Nsf is insufficient funds. This is where someone paid the business with a check, and that check did not clear the bank. Shows any service charges, interest earned, right, or interest expense that might have been taken out. Shows all kinds of things. Okay. So here's an example of a bank statement, or partial bank statement. Just make it bigger to look at it. Sounds a little clearer. All right, so when you get a bank statement, a lot of you might just get the bank statement online. You may not get a paper bank statement anymore. So you have the beginning balance at the beginning of the month, plus your total deposits, minus your total withdrawals, which could be checks or debit cards or electronic fund transfers, whatever. Any service charges, and then the ending balance. And then they'll list everything out, for you. So like we've got some deposits that were actually made by the bank, or by the corporation into the bank. Then this one was an EFT collection. So the bank collected $100 for us from somebody. Then we earned some interest. Then they took out a service charge. And then here are the checks that cleared, where I actually wrote a check. This is more where money came out, but it's either through electronic fund transfers. We paid the water bill. And then here's the Nsf check. somebody wrote us a check that was deposited and then their check did not clear. And we'll learn how to account for all that. All right, so let me tell you how to set up a bank reconciliation. Bank reconciliation format. All right, so generally you start on the left-hand side with the balance per bank. And then to that balance, you're going to add deposits in transit. All right, these are deposits that you have actually made in the bank, but they haven't hit your bank statement yet. So for instance, let's say my bank statement is dated October 31st, and on October 31st, after 5 o'clock, I drop off a deposit. And that deposit probably is not going to make it on my bank statement that's dated October 31st because I made it after 5 o'clock. So it's not going to hit it quite yet. So that would be a deposit in transit. Then you're going to subtract outstanding checks. Outstanding checks are similar to a deposit in transit, but it's where you've written a check and it has not yet cleared the bank. All right, whoever you wrote the check to hasn't put it in their bank yet, and it hasn't been collected yet. So, but you've written it, you technically don't have that money anymore, and that's an outstanding check. And then there could be other stuff, all right? You're going to have, plus or minus errors. Generally, it's just going to be errors on the bank side. So plus or minus miscellaneous errors usually. And that gives you the adjusted cash balance. Then on the right side, you would have the balance per books. All right, the books are our accounting records. All right, so it's the balance in your cash account on the general ledger. Okay. Oh, I should put this down here. Crazy. All right, so the balance per books, you're going to add things. You're going to add or subtract items that are on the bank statement that you have not yet put in your accounting records. So you might want to add Eft Collections by the bank. Any interest earned. Those are the main ones. I'm going to say miscellaneous other because there could always be other things. And then you're going to subtract electronic fund transfer payments, Nsf checks, service charge, and then miscellaneous other. And miscellaneous other might be errors. All right, I might have an error going either direction, and I'm going to add or subtract that. And then I'm going to have an adjusted cash balance. And these adjusted cash balances, they should equal each other. Okay, so here are the ones for the example. They have a deposit in transit of $9,000. So if you remember, we're starting off with We're starting off with 12,470. Actually, we're starting for 12,720. Okay, now you're not completely done yet because the balance in the cash account has to equal this 19,720 when you're done. So you have to do journal entries for the items that affect the cash account. All right. So let me write that out so you've got that. Journal entries are required for items that affect the cash account. The cash balance on the books should equal the adjusted cash balance on the date of the bank statement. A lot of times you're not doing this on the exact date. It's because, the bank statement might be dated the 31st, but I may not actually get it until the 3rd, and things have happened by then. But I need to go back and make sure that I make these entries and that the balance that carries forward from that 31st date equals the adjusted cash balance on the bank reconciliation. Okay, so in this case, my journal entries would be, I'm going to do them over here underneath it. We can kind of see them. And what I'm going to do here, I'm going to put like a 1, a 2. I'm going to number them. We're going to have 5 journal entries here, okay? Maybe I should put these over here on the other side. Okay, so for the Eft collection by the bank, let's see what this, it was a receipt from a customer. All right, so it was a customer that owed us money. So for the first one, we're going to debit cash and we're going to credit account receivable for the $100. All right, the second one was interest earned. Cash went up, so I'm going to debit cash and I'm going to credit interest revenue for the 30. All right, then on the third one, this is an Nsf check. So if somebody paid me and I said cash and accounts receivable, and then their check bounced. So now I need to reverse that original entry. And I need to put back my account receivable back on the books because now they owe me that money again. And I need to credit cash because it came out of my cash account. I had added it in and I have to take it back out. All right, the fourth one is a service charge. So once again, I'm going to credit cash. I'm taking it out of the cash account. And I'm going to debit bank expense for the 20. And then the fifth one was the water bill. So I'm going to debit utility expense and credit cash. All right, then these entries get posted to the cash accounts. Was it 40? Mine are in a slightly different order than theirs, so don't worry about the order. These get posted to the cash account and the other accounts in the general ledger, and then cash is updated, and the balance at that date should equal the 19,720. All right, and that is it. I will go work a couple of exercises.